Okay, thanks very much, Karen. So, as you can see from the title, this report provides a broad overview of the issues in this very complicated area. It would be difficult for me to do justice to the report in the 15 minutes or so that I have to speak tonight. But what I am going to do is I'm going to discuss the 4 key points that we pulled out of the report, and hopefully that will give you a taster of the report. And those of you that are interested, I hope that you'll go on to have a closer look at the report and read those sections that you're interested in. Before I begin, I'd like to acknowledge the UK Institution of Civil Engineers that funded this research through its Research and Development Enabling Fund. I also need to tell you how we're defining infrastructure in this project. So we take a broad definition of infrastructure that includes the standard definition of economic infrastructure, which would be transportation, telecommunications, energy, irrigation, and water and sanitation. But we're also including buildings and the built environment in general. So pretty much anything that involves engineers. Come up? Yeah, okay. So the first key point that emerges very clearly from the project is that infrastructure policymakers and practitioners have an absolutely crucial role to play in meeting the challenge of climate change in the developing world. So if we talk first about mitigation, if you just look at the left-hand side of the pie chart, you can see that the reddy-orangey sections are infrastructure sectors. So they already, the power, transportation and building sectors already account for around almost 50% of global greenhouse gas emissions. But also, around half of the industry segment is due to those emissions are due to the production of cement and steel, the vast majority of which goes to the construction industry. So in fact, the construction and use of infrastructure assets is responsible for more than 50% of global GHG emissions. It's also important to understand that it is feasible to reduce emissions to zero in all of these sectors. So that's in contrast to example for agriculture, where we believe it's impossible to reduce emissions to zero. So given the urgency of the challenge of mitigation, climate change, and the small timescale we have, it's essential that we do this as quickly as possible. And reflecting something that Karen mentioned in the introduction, perhaps the key point here is that action in the infrastructure sector is urgent. Now, this is because infrastructure assets have a long lifespan, normally between 60 to 100 years. So obviously rates of growth and rates of investment vary a great deal between different countries in the developing world. But many fast-growing developing countries are investing huge amounts of money in infrastructure assets at the moment. So if those countries are not able to integrate mitigation considerations into their infrastructure policy, their planning and their infrastructure design, they risk becoming locked in to high carbon growth paths for really quite a long period of time. And that period of 60 to 100 years is absolutely critical for the climate. But of course, these countries may also risk their opportunities for economic growth if they're not able to adopt low carbon growth paths, because it's during that period of 60 to 100 years that global emissions limitations must start to bite. And then if we move on to looking at adaptation, so this is a calculation from a recent World Bank report, the cost to developing countries of adapting to climate change. And we estimated that around 75% of the total investment required in the developing world to meet adaptation needs will need to go to the infrastructure sector, taking the broad definition that we use in this report. And that will go, there's 2 main uses for that investment. The first is climate proofing infrastructure across the spectrum. So investing in new infrastructure to ensure that it's climate resilient, and also retrofitting existing infrastructure. And secondly, investing in what we call dedicated adaptation infrastructure. So this is infrastructure that's specifically designed to protect human settlements and natural systems from the impacts of climate change. So examples would be flood defences, coastal protection, and some agricultural infrastructure in areas suffering from drought or saline intrusion. Now, once again, action in the infrastructure sector is urgent. Almost every infrastructure asset currently being planned will be affected by future climatic change due to the long lifespan of infrastructure assets. And again, if countries are not able to integrate adaptation considerations into their infrastructure planning and design, we risk a range of outcomes from sort of suboptimal investment, which developing countries can ill afford, right through to potential sort of catastrophic failures. So just to sum up, infrastructure policymakers and practitioners have an absolutely crucial role to play, and action in the infrastructure sector is urgent due to the long lifespan of infrastructure assets and the rapid rate of accumulation of infrastructure assets in many developing countries. So moving on to the second key point emerging from the report, we identified 3 key challenges. So 3 key challenges to meeting the challenge of climate change in the developing world. The first, and I think the least talked about, is capacity. So of course there are capacity challenges in government, the private sector and civil society. But we focused in the report on capacity challenges in government, as we see government as the key enabler to meet this challenge. So we're talking here about capacity in government to develop and implement climate change policy frameworks across sectors and also across scales, so from national government right down to local government. Now I should emphasise, of course, that capacity levels vary a great deal between developing countries, and also this is certainly not just a developing country problem. I mean, I think many people would argue that we're not doing too well at this in the developed world either. Nonetheless, it's a very daunting challenge, particularly for those countries with very low capacity levels. The second key challenge is finance. I'm not going to talk about that in detail here. I could be here all week talking about climate change finance, and I'm sure many of you in the room know a great deal about it, but there's a lot more in the report. The third key challenge is technology. So if we are to meet mitigation targets within the timescale required, it's urgent that we disseminate existing low carbon technologies and also develop new low carbon technologies. But it's also important to say that in many ways these 3 challenges are linked. So if we take technology transfer, for example, technology transfer is not a simple process. It requires a certain level of capacity, absorptive capacity, on the part of the receptor. So it requires a certain level of technical capital, of human capital, and also institutional arrangements, for example, intellectual property laws. And also if we look at finance, I mean, this is a conversation which in my experience we don't hear very much, but there are real questions over whether, if we are able to raise the hundreds of billions of dollars a year required for adaptation and mitigation investment in the infrastructure sector in developing countries, there are many countries which may struggle to actually absorb and use that finance. There are countries which are perhaps at the limits of their absorptive capacity, and particularly in the infrastructure sector, we see a great deal of challenges already in sort of developing infrastructure in a way that promotes growth and poverty reduction. So again, perhaps the key point from this slide is that efforts to raise finance and to transfer technology stand a far greater chance of success if they go hand in hand with demand-led capacity building programs for governments. Moving on to the third key point. So the third key point is that climate change has created opportunities as well as challenges in the infrastructure sector. And it seems very important that developing country governments are aware of these opportunities and are able to take advantage of them in order to counteract some of the negative impacts that climate change will inevitably create. So the first of these is access to new sources of finance. So the costs of greenhouse gas abatement are generally lower in developing countries than in the developed world. So that means that mechanisms such as carbon markets and perhaps in the longer term sort of carbon taxation and other mechanisms will steer investment towards the developing world. And some developing countries may be able to harness this investment to develop a stock of green infrastructure, and in that way to promote economic growth and pro-poor growth. So unfortunately this is not an opportunity which is equally accessible to all developing countries. it tends to be more accessible to middle-income, more industrialised developing countries. And the reasons for that are that there are greater abatement opportunities in those countries because they have higher emissions, and also because they have better investment climates. And we can see that, for example, in the distribution of investment from the Clean Development Mechanism. The second opportunity identified is green jobs. So the transition to low carbon production will go hand in hand with the transition in the labour market. And it's predicted that that will generate green jobs, particularly in the renewable energy sector and in the building sector. Now again, it's important to emphasise that in order to harness the advantages of these new green jobs, that will require sort of well-designed government policy as well. The third opportunity identified is potential synergies between climate change investment or climate change activities and developmental priorities on the parts of those governments. So with adaptation, many people argue that in fact investments and activities to promote adaptation it's difficult to distinguish them from development. And in fact, really there's very little difference between adaptation and development. So those synergies are perhaps more obvious, but for mitigation, it's not so obvious, but there are potential synergies. A classic example is in countries in which there is scarce access to modern energy sources in rural areas. So renewable energy is far more amenable to decentralised networks than fossil fuel-based energy production. So imagine if a country is able to access international financing sources for green energy that could potentially be used for decentralised renewable networks, which would promote green growth, but also pro-poor growth. And there are many more examples. The final example is moving on to adaptation now, so to maximise the developmental outcomes of adaptation investment in the infrastructure sector. So as we all know, the impacts of climate change will be felt most by the poorest and most vulnerable. So it seems extremely important that every dollar of investment in infrastructure for adaptation creates the greatest developmental outcomes possible. So there are tried and tested methods for maximising developmental outcomes of infrastructure investment. And this is an area in which EAP has done a lot of work. So they include comprehensive stakeholder engagement, adopting community-driven approaches where possible, and promoting local content. So creating as many local jobs as possible, but also providing opportunities for local businesses. So moving on to the fourth key point. This is going to take a little bit of explanation, so bear with me, but I think this is one of the most interesting points in the report, so I think it's worth going through. So this relates to an analysis that we carried out of the funding flows from the climate funds being multilateral and bilateral funds, donor funds designed specifically to channel funding to climate-related activities. So from the climate funds, and we also analysed funding flows from the CDM to infrastructure, and we looked at that by country and by sector and by income level. So just to give it a bit of background to this slide, there have been various attempts to work out what an optimal distribution of investment for mitigation would look like across the globe. Okay? Now, the most comprehensive of these that we found was a report published in 2009 by McKinsey & Company called Version 2 of the Global Greenhouse Gas Cost Abatement Curve. Okay? That really gets your heart racing. So we looked at that report, and basically what that report, what that study shows or claims is that the infrastructure sector in which we should be investing most between now and 2030 is the building sector by a significant margin. Okay? Not the energy sector, the building sector. So why is that? The reasons for that are that the technologies for zero carbon buildings at a global scale already exist, unlike in the energy sector. That's the first reason. The second reason is that over the lifetime of the investment, it's actually cost efficient. You save investment. So this is because of efficiency savings, essentially. So in other words, the net cost of reducing emissions from the building sector to zero in the long term is negative. You actually make savings. So then we went on to compare this with the distribution of funds from the climate funds and from the CDM. Now, as you can see from the pie chart, around 50% of funds from the climate funds flowing to the infrastructure sector is going to energy, and only around 14% to buildings. And the distribution between energy and buildings is very similar for the clean development mechanism, about 50%, and between 10 and 15% for buildings. Now, this is not a complete analysis of funding flows to the infrastructure sector, of climate-related funding flows to the infrastructure sector. We were not able to include other donor flows that do not flow through the climate funds, and we were not able to include private sector funding flows. However, I do think this throws up some serious questions about whether these funds are being used in an optimal manner. Essentially, the climate funds and the clean development mechanism are designed to correct a market failure. So I think it throws up questions about whether that's been done in an optimal way. We can't say for sure, but perhaps the key point then emerging from this is that a more thorough analysis of funding flows to the infrastructure sector needs to be carried out. It would be a worthwhile activity. Okay, so that was a lot of information. I'm just going to sum up now. The 4 key points again are, so policymakers and practitioners play a crucial role. The 3 key challenges we identified are capacity in governments to formulate and implement climate change policy, raising necessary finance, and developing and disseminating technologies. There are opportunities as well as challenges resulting from the challenge of climate change in the infrastructure sector. They include access to new sources of finance from donors and from mechanisms such as carbon markets, so currently the clean development mechanism mainly, green jobs, and the potential for profiting from synergies between climate change initiatives and developmental priorities. And finally, that donor and donor leveraged infrastructure funding may not be flowing optimally. There's a lot more analysis of this in the report, so if this is an area that you're interested in, please have a look and get in touch if you have any comments. I mean, another key point is that the proportion of funding flowing to adaptation infrastructure from the climate funds is very small, around 2 to 3%. And again, we can't say what is the optimal distribution, but that does seem very low. Great. Sorry, one more slide, Garrett. So we have many recommendations in the report. I'm not going to go through all of them now, but just to say 2 of them are, firstly, for donors to provide greater support to partner country governments in developing climate change policy frameworks and building capacity. And I know that the Climate and Development Knowledge Network recently launched a user's guide to climate planning tools. So that's one step towards this. And secondly, for donors to scale up, coordinate and balance funding flows for climate-related infrastructure investment. And of course, a key first step to that would be to carry out a more thorough analysis. Thank you.
Great. Thank you very much. I think that was a very nice, clear and concise summary of the key findings in the report. Perhaps particularly interesting this issue around whether we are spending relatively too much on energy, which is the flavour of the month, obviously, and relatively too little on infrastructure, on buildings infrastructure. So that's a very interesting finding for further discussion. I want to